Here's our agenda for today, and thanks for coming. All right, so Professor Velasco, I'm the faculty sponsor for Moneymakers Club, and thanks to those that are joining us online via WebEx, which is a new thing for us. I'm in this smart classroom here at the Fintech Center at Kent, and as long as your name's on the screen, if you're in one of my classes, you'll get extra credit. If you are physically here and are in a class, and you get the extra credit for signing in. So all of our, I don't know why. Oh, I know. Let me move this guy here so you guys can see what I see. All right, so all of our topics are always member driven, and most of our members are beginner investors. We have a couple more seasons, but the majority of ours are beginner investors. And we always like to take suggestions from all of our members about what topics we want to do each month. So welcome. First of all, let me I have the chat box up too. See the chat from our streaming audience. Are there, well, let me say I'm Professor Velasco. I teach 4 different finance courses. I'm the club sponsor for the Moneymakers Club. Finance is my background. Or at least it's what I did postgraduate school. Undergrad's in accounting, so I kind of did both. I trade options every week. Actually been doing a little more trading this week. Still buy stocks every month, but I don't have to babysit those. And the goal of the Moneymakers Club is to try to teach individuals to be able to build wealth on their own without having to pay someone else to do it. So I like to empower people with knowledge so that way they can take control and build wealth through knowing about all the different types of assets that you can invest in. And we talk about anything from real estate to commodities to stocks, bonds, options. A couple months ago, we had an interest from one of our members to talk about investing in art. So which was kind of interesting. And I try to make handouts, educational handouts that we distribute to all of our members. And after this meeting, I will always email all the handouts that we have in person, so that way you guys will have it too. And we meet once a month, usually on the 3rd Tuesday of each month. But this month, that 3rd Tuesday was my birthday, so I made the executive decision to celebrate my birthday instead of having our meeting. So I just pushed it back a week. So thanks for waiting a week till we had our meeting. We should be back to the 3rd Tuesday again, normal schedule when we come to March. Or we might have to work around spring break. I know spring break's next month too, so we'll see how it goes. So before we begin, one of the first items on the agenda is survey of future topics. So are there any topics that any of you, both online or in person, may want to suggest to talk about for our March meeting? None come to mind in the in-person audience? Anybody online got any topics they might be interested in talking about? Okay. Well, one of the topics, or actually 2 of the topics that we're talking about this month came from members. Hey, Timothy. Member suggestions. One from last month's South Campus meeting was a suggestion about what to look for in an underlying stock. So if we're shopping around for a stock, what are some of the things that we want to look for? And then another one was from a suggestion from one of our signups from last month's club fair, who's very interested in cryptocurrency. So I decided to bring back a handout on what is altcoins. So that's kind of interesting to talk about the distinction between Bitcoin and other alternative cryptos. And then finally, I have just a mathematical handout that I'm going to share with you, which should take a couple of minutes to show and illustrate why it is challenging after an investment drops in value to try to come back and break even. because it's not as easily mathematically as you think, because it has to climb back a lot harder. And I can show you the numbers and how that works. So for the first one, let's talk about next agenda item. What has the market been doing lately? Well, we've had a couple of key metrics that the Federal Reserve has been looking at to try to make a decision on whether or not to raise interest rates. And one of them, of course, is consumer spending, which is actually a major index that the Fed looks at. So consumer spending went up higher than expected by 0.6%, at least according to analysts, a significant amount. And that raised fears at the Federal Reserve, because inflation is still high. They might raise interest rates at least 0.25% next month, or maybe even 0.5% next month. And so that's pretty big. And we know how painful it is to pay more for everything, stuff, clothes, food, gas. And inflation right now is hovering at about 6.5%, which is still outrageously high versus the inflation that we were blessed with over the last almost 3 decades. So that's something that might scare the Fed into raising interest rates. And another thing was producer price index. So the cost of goods when manufacturers make stuff, that's gone up in value too, a little higher than expected. So those two metrics have been stoking fears in the stock market that interest rates may go up. And the reason why the stock market may drop or may fear interest rates going up is because there's kind of a domino effect. Interest rates go up, the cost of businesses to raise money, the cost of businesses to pay expenses goes up. Because when there's more interest expense, that decreases profits, that decreases the bottom line. When that decreases the bottom line, earnings goes down, and then earnings per share goes down. When earnings per share is projected to go down, then the stock price may go down. So the stock market is a forward-looking indicator. So when you hear things about the economy going up and down, and you see the stock market not necessarily rising and falling to where you would expect it to be, it's because the stock market is always a forward-looking projection of the future. So we've been in a bear market for over a year now, and so it's basically projecting that we may end up in a recession at some point. Personally, I think we've been in a recession already, because we can kind of feel with how tight the labor market is. There's still a lot of people unemployed, especially in the service industries. Prices for everything is going up, and people's disposable income is going down. Their real purchasing power is going down due to inflation. So people are going to spend less money. When people spend less money, then businesses are making less money. When businesses make less money, eventually they might have to cut things. They have to cut staff. All the big boys, every single big boy tech firm, Alphabet, aka Google, Facebook, Microsoft, they're cutting jobs, thousands of employees at a time. Amazon cut a few thousand jobs. So that's kind of a harbinger of what might a possible recession. Job market's still tight, wages are going up, so that's one thing that some analysts and economists are thinking that might make the recession kind of not as hard or as severe, because the job market's so strong. But time will tell. But I think all of us are feeling the effects of inflation. So that's kind of like what the market's been telling us lately. Matter of fact, last week was the biggest drop in the market for a week so far for 2023. So last I checked, it was trying to come back. Dow's down, but the S&P and the NASDAQ were just slightly up. And it's earnings season, so companies are coming out with earnings. I think Target just came out with their earnings today. Here's one. I'm going to share this screen with you guys. Make a little where I can move this one tab over here. So if you could, I put this together just to show you at various price points, and this could be for any investment, whether it's crypto ETF, a portfolio, or even a stock, if you see a drop, and we've seen these drops over the past year, tech stocks have dropped 20, 30, 40, sometimes even 50% or more in 2022. So if you got an investment that's $100 and it drops to $70, that's a 30% drop. That is a bear market drop. Well, in your head, you think intuitively, well, if it goes up $30, then, or if it goes up 30%, I can get back to even. Mathematically, that's not true. It is a bigger percentage to climb back to even. So mathematically, to get back to the same $100 to recover that $30 that you lost, even though it dropped 30, it needs to come back 43% to get back to even. So it's a bigger percentage than the percentage that actually dropped. And a lot of people don't realize this. Let's look at a round number that we can easily understand. We got an investment that's $200 and it drops in half to $100. We think, okay, well, if it dropped 50%, I need to go back up 50% to break even. No, it needs to actually double just to get you back to even. Because 100% of $100 is $100. So 100% means you need to double your investment to get you back to even. Because 50%, which dropped, a 50% growth is only another $50. You're still at a loss at 150 versus 200 if it goes up 50. You need to go 100%. What about a small affordable stock? $10 stock drops 40% to $6 a share. Well, that 40% drop is not enough. It needs to go back another 67% to get you back that $4 that you lost. So it's always a lot harder than you think, is my point, to get back to even after a long drop. Again, if you haven't sold, it's a paper loss. But again, you got it. As long as nothing has fundamentally changed on why you bought that investment in the first place, give it time, it can go back up. But if something has changed as to why you want to hold on to that investment, you could tax harvest the loss and use it to offset your gains, and then put your remaining funds into something that might be better use of your investment money. So that's that. Next thing, which was one of our most requested ones from last month's meeting, was things to look for in an underlying stock. And I brought this back just because this is something that a lot of us should know, but a lot of us maybe not realize its importance when we're shopping around for a stock. Let me see if I can make this a little bigger. I put at the top my number one rule. I learned from one of the best traders who owns AC Trade. It's liquidity. And for both buying stocks or trading stocks, and especially trading options, liquidity is the most important rule, the most important metric as a screener when you're shopping around for stocks or any other types of things, ETFs even, to trade. And the reason why liquidity is important because it has enough shares of it being traded on any given market day. And because it has enough shares, it ensures that you're going to get as fair a price as possible for what you're buying or selling. Because if it is illiquid, if it's not readily traded, there's going to be such a gap between the price that people are willing to buy the stock versus what people are willing to share a stock. And let me illustrate for you what I mean using some real examples. So let me go to easy site. Yahoo Finance is pretty intuitive to take a look at when you're looking at stock information. So let's take a look at first stock I ever bought, Microsoft, when I was still in school, and take a look at its liquidity. So let me share this on the screen with you guys. Online. All right. Hopefully you can see that. All right, so you take a look. Microsoft is a very liquid stock. Its volume is right now is 8.7 million shares. Easily surpasses a million shares traded for liquidity. Take a look at what I mean about getting a fair price because of its liquidity. If you look at the bid and the ask price, people are willing to pay $251 a share. There's a bid for $251 a share, even for a share of Microsoft. And then people that are wanting to sell a share are asking $251.01. There can't be any closer of a gap between the bid and the ask price in Microsoft right now. And this is live right now. So again, this is an illustration of why liquidity is so important. You're going to get as fair a price on the market for that asset that you're wanting to trade for. Now, let's take a look at something illiquid. Say, think of what might be less liquid. What about, yeah, well, it's actually not too bad, but I mean, for the spread, this one's only 670 million shares, although their average volume is 2 million shares, so they're fairly liquid. So it's about a six cent difference. So that's not too unfair of a price. I think a better example would be this stock. Berkshire Hathaway A shares. So their average volume, well, their volume today is 3,676 shares. So there's about over a $400 difference between the bid and the ask price. Very illiquid. It's really hard to get a fair price between these two ranges because you don't know if it's too high or too low, just because the difference between what buyers and sellers are asking for is so wide. And when you're talking about low price stuff, and I usually classify penny stocks as anything less than like $8 a share. So sometimes those may seem attractive. I can get a bunch of shares for just a few dollars and trade them. Well, yeah, but a lot of those penny stocks are illiquid, meaning that there's not that many shares traded. So you could not get as fair a price for those shares, either as a buyer or seller. But what's worse with a lot of penny stocks is that due to illiquidity, you might be able to have trouble getting rid of them if you need to. I have a real story. One of my best friends, again, got a doctorate degree, real smart, PhD. He got a tip from another PhD guy who bought some, which I realized was a scam, thought growth penny stocks that were purportedly growing new crops in a field out in California. The stocks were selling for about 25 cents a share, and you can get thousands of them. And he was trying to get my friend into it, and my friend took me to dinner saying, hey, I got an opportunity for it. I want you to see what you think. And so after I got home from dinner, about 10 o'clock at night, doing research, found that the company looked like they were operating out of a strip mall, and then their press releases were bought. And so I called my friend, because I couldn't wait until the next day. I said, it was 11 o'clock at night. I said, hey, I'm not advising you what to do with the stock, because he'd already bought shares. I said, but this is what I found. And this is what I found through Google Maps about what the lot looks like and what the business looks like. And here's who they paid to put out the press releases, because these weren't real news articles about what they were growing. And the fact that his friend, another PhD guy, heard a lot of people in the background, like a call center, calling about the stock. And I go, that sounds like a boiler room. Literally like the movie Boiler Room, or literally like the Wolf of Wall Street, where they have a call center trying to call people about stocks. And so he immediately said, man, I feel sick. I got to get rid of my shares the next day. Well, he had bought about 8,000 shares. Got to do it. And he tried to get rid of 8,000 shares the next morning. And because it was so illiquid, there were only thousands of shares traded that day. It took him 4 separate trade attempts to get rid of 8,000 shares because there weren't that many buyers out there for it. So liquidity, again, number one rule, get the best price, and also enables you to execute your shares within seconds when you need to. both as a buyer and a seller. So that's very important. Number two, market cap. Try to stick with companies with about $1 billion. So these are mid-sized companies. I know $1 billion sounds like a lot, but a mid-sized company is about anywhere between 500 million to 2 billion. So if it's at least $1 billion in value, and you may hear on the news, maybe like a tidbit if you don't follow the market saying, oh, Apple's the first $1 trillion company, or Microsoft is now a $1 trillion company. That's what they mean. What is the company worth? And it's really just however many shares that exist or outstanding times what the current dollar value is of those shares. So Microsoft, solid company, not going out of business anytime soon. It has a market capitalization $1.869 trillion. So not too shabby. So they by far, by almost 2,000 times meets my criteria for being a big enough company. So, and market capitalization basically is the market reflecting by buying and bidding up those shares to a certain value that it is worth investing in. So this is the investor community suggesting that this company is worth the investment by its valuation. Price per share should not matter if you are buying quality. And this is one I bought my first stock all the way till now. I was working a part-time night job when I was still in school, answering phones, and I spent some of my part-time money buying my first 10 shares of Microsoft. Back then, it was $150 a share for college students, a lot of money. But because I knew that they made a product that was almost universally used throughout, and they came out with Xbox too, I was okay buying 10 shares of Microsoft. I still own the share. I'm not going to sell it anytime soon either. Because I would rather have one share of, say, Amazon than 1,000 shares of an unproven penny stock that might drop in value overnight. I could sleep better well at night. I call it the SWAN test, sleep well at night test. So unless anything has fundamentally changed, I usually try to look for companies that have quality. And I was talking to me about quality. It could be increasing revenues. It could be a trend of increasing profits. It could be a very strong moat to where competitors are would find it hard to challenge them on the market. So a lot of different reasons why you'd want to buy quality. And speaking of, one of the metrics of quality is, does the company have increasing revenues? One thing that can be manipulated, and I used to be an accountant, you can manipulate earnings, but you can't lie on your sales. So sales revenue, and let's take a look at Microsoft again as an example, is we can look at the financials. So looking on their income statement, this is an admin in the way here. So total revenue, here we go. 2021, 168 billion. 2022, 198 billion. So increasing revenues, that's a good thing. If I can turn to the other side of the screen, maybe I can with the other. I guess Yahoo doesn't want me to see what 2020's revenue. Oh yeah, there we go. 143 billion. So definitely increasing revenues. That's a good sign. You can't lie on your sales. I mean, you can come up with all sorts of paper expenses and things like that, but sales are hard to fabricate. So increasing revenues, definitely a metric that we want to take a look at. Does it have increasing profits? Yeah, we want to take a look at that as well. And that's reflected as their earnings per share. So we've got, let's squeeze this over a little bit. Yeah, oh yeah, big trend. $5.06 a share, $5.76 a share, $8.05, $9.65. Microsoft's earnings are robust has a really positive trend of increasing, and that's attractive. That's very attractive as a metric for investing. Samantha, what about solar and wind energy stocks? You see them growing over time. I do. I do see them if they have the infrastructure support of federal infrastructure investments. I know with like the Build Back Better bill that passed, they allocated a lot of money to solar and wind energy stocks. I think in particular, Samantha, the solar stocks have done pretty well. Trying to think, there was one in particular that I remember, but I forgot the ticker symbol off the top of my head. Solar has done pretty big, and of course, you can invest in large companies that have solar as one of their product lines. If you may be already aware, Tesla is a solar provider as well. One of their business lines is huge solar panels to not only power homes, but they're also there to power the Teslas that are parked in the garage of those homes as well. So if I had to choose, I'd probably go solar. Wind, there's something where some stakeholders think that wind is not as environmentally friendly. They haven't found a way to make it as efficiently as solar, and the construction of the materials for the wind farms are costly, and plus there's also stakeholder complaints that they're just not attractive. Having a whole wind farm out in the countryside, just not as pretty to look at. Solar panels, on the other hand, I think has gotten a little more press because I think they're really trying to put in some efforts to try to decrease every year the cost of the cells to power solar. So if there's one I'd probably lean on, it's probably that one. And I wish I remembered the ticker symbol of one of the companies that is on the solar bandwagon. I'll probably remember if I don't think about it. But yeah, great question. Does the company pay a dividend? Not all stocks pay dividend, but one of the two ways that we want to get a return on our investment is capital appreciation, meaning that the price goes up more than what we paid for it, and income. So stocks that pay a dividend, and I'm going to go back to our friend Microsoft. Not that their dividend is really that sexy, but they do pay a dividend. So dividend and yield, 1.09%, so about as good as what you get on a savings account, but Microsoft has had a solid track record of growing the dividend every year, meaning they give you a raise every year. So they're paying $2.72 a share. So we want to look to see if it pays a dividend, but we want to look for companies that have grown their dividend every year. And there are two classifications or two terms that I want you to get yourself familiar with, and you can Google them: dividend kings and dividend aristocrats. Dividend kings are a handful of companies that have not only paid dividends every year, but have increased their dividends every year for 50 years straight. And a lot of these companies, you've probably heard of them. You've probably heard of like Johnson & Johnson, Coca-Cola, for example. And then the dividend aristocrats are just as good. It's a bigger list. These are companies that have paid dividends for at least 25 years straight and have increased them every year for 25 years straight. So we've got your Home Depots, you've got your Johnson & Johnson, you've got your Coca-Colas, you got your Pepsis, you got your Microsoft. I think Microsoft might be closed. I remember when Microsoft started paying their dividend just a few pennies, so they've grown it quite a bit. So that is a good metric that you want to take a look at when you're screening stocks. Next one is, what do they do? Do they make products and services that will sell? So we're in a recession right now, in my non-professional economic opinion. But think back to 2020 when we had the pandemic. What was selling? Toilet paper, spices, soups, necessities, deodorant, especially deodorant. Imagine everybody had to be cramped in their homes for a while. So look at what they do. Are they selling products and services that are resilient regardless of whether we're in a booming economy or a recessionary economy. So, and what about competition? See top competitors to each other. I've always preferred Pepsi. Prefer buying shares of Pepsi because they don't just make drinks like their slogans. Pepsi, they have fruit flies, they got Gatorade, they got they got Frito-Lay, they got Eagle Snacks. So a lot of stuff, food and drinks, and both global companies, both good investments. I just like the diversity of the product line. You need to be market aware around what is affecting all the companies. So competition, technology, and lawsuits. One reason why I stopped trading Facebook some years ago is kind of threw me off that they were getting so much government scrutiny and the stock was suffering because of all the bad press with privacy laws and having non-culpability for influencing a lot of extreme groups and their posts and stuff like that. Meta stock's done great this year, but I'm just kind of wary about it still. But I'm all into other tech that's not as controversial. So take a look. I always look at the news differently. I mean, I don't watch Trump as much as anyone else, but I mean, politics and fluff, easy for me to ignore, and I don't get talk about it because one question is, do I need to pay attention to it because it can make me some money? If not, then I can easily ignore it. And I'm not going to let it stress me out. A cursory look at the 52-week chart. And again, just to do your time, you can look at charts in any financial website. But take a look at how the stock has been performing over the past year. I like to look as a trader. I like to look at what the stock's been doing over the past month. Is the trend going up? Is the trend going down? Is it an opportunity to buy, or is it not? You know, if I see a chart that looks like it's continuously heading downward, I think maybe it could turn around, or I could be catching a falling knife to hurt myself if they go wrong. The last one, technicals. There are people that trade stocks and don't forget what it does. They're simply looking at charts. And if you have the time to look at charts maybe all day or several times a day, technicals may work. It's tough for folks that have regular jobs to use technical trades because they have their own jobs to do during the day. But again, it can work if you have the time for it. Beta, I'm going to skip on beta because that's pretty easy, but I don't want to take the time to do that one. If you're interested in explaining beta, I can do that. 50-day versus 200-day moving average. If you don't know anything about technical trading, there's one technical trading technique that has worked and will probably put you ahead of most people that don't know anything about trading. Look at the 50-day versus the 200-day moving average of the stock price. If the 50-day moves above the 200-day average, you can put them both on the same chart. And if the 50-day moves above the 200, that usually signals a bearish move. Bullish move, meaning the stock is probably going to go up. And that's called a golden cross. That's the nickname for it. If the 50-day average goes below the 200-day moving average, that is called a death cross, meaning that it is probable that going forward, the stock may move bearishly downward. And you can trade both ways. I try to make money both bullish and bearish because it doesn't matter which way the market's going. You can make money no matter what the market is doing. Right now, most of my trades are actually neutral trades, meaning that I am picking stocks that hopefully going to stay within a certain range. And as long as they stay in that range, I'll make some money. And then I have a couple of bullish bets, but that's still in the minority right now. Until I see a real bull market, I want to kind of stay a little neutral because the Fed still needs to make some decisions. So that's a little bit about my handout about what to look for on an underlying stock. And we'll close the meeting today with the last handout I've got, which was requested by one of our new members who wanted a discussion on on crypto. And so I decided to talk a little bit about altcoins because we know what Bitcoin is, but altcoins are more interesting because that's everything else. But what most people don't realize is we can categorize altcoins into different buckets as investable assets. So an altcoin is basically used to describe any cryptocurrency that's other than Bitcoin. Even one of the big boys, which is Ethereum, is still an altcoin because it's just not Bitcoin. Bitcoin has dominated the overall capitalization of crypto. That is the most invested cryptocurrency out there. And cryptocurrency to me is kind of a misnomer because it's a commodity. It's an investable asset like a commodity, but it's not a currency really as classified by the IRS. And sure, people may use it to pay for stuff, but a lot of it is the underground economy. So major financial institutions have finally started devoting resources and staff to crypto because their clients are savvy enough to want to invest in crypto. So the big boys like Morgan Stanley, Bank of America, they can't get away with it. They have to take it seriously. That's what their investors are going for and wanting to diversify their portfolios into cryptocurrency now. So they have no choice. Now, here are the different types of altcoins that are out there. The first one is called tokens. So these are used for peer-to-peer payments. So they try to make these cryptos as a way to actually pay transactions. So examples, Bitcoin falls under a payment token. There's ACH, and there's Litecoin, so LTC. The next type of alt currency are utility tokens. So, and again, I got this definition. Supports a transaction power on the token's blockchain network. That's actually what all cryptocurrencies are. These are products of a blockchain network, and a blockchain network is designed to decentralize the network, decentralize transactions, financial transactions, and also to provide security, like for contracts. So utility tokens, what are these? Utility tokens are this type of alt crypto, includes cryptos used to pay for network gas fees, which is a token required by the node operations of a network, or a token that entitles the holder to a portion of revenue. So Ethereum and Solana are the two preeminent cryptos that fall under the definition of a utility token. I actually prefer Ethereum as a utility token, but I also prefer utility token as my crypto of choice. It's got a growing market cap, and then last fall, there was this a software upgrade because they are no longer proof of work, it's proof of stake now. So which makes it about 90% more efficient and takes up a lot less energy versus Bitcoin, which is the biggest criticism of Bitcoin, that it takes a lot of energy. A governance token. So entitles the holder to influence development of a network as it represents voting rights on management of that network. So if you have a governance token, you can approve or reject proposals to change the network. The only example I could find is UNI, UNI. Stable coins, basically these are pegged to a real currency like the dollar. So these are a way to, it's kind of like its own version of a money market account. It's designed to preserve the value of a dollar. It is not meant to go up or down in value. It's supposed to stay the same. So USDC and USDT are pegged to the US dollar. I got $1 worth of USDC for doing a free survey online, so I'll do something for a free dollar. But that's actually what these are designed. They are in the future. I guess the designers hope that people would want to have a crypto pegged to the dollar to have as a currency, a store of value that doesn't fluctuate as other cryptocurrencies do. I don't know how many years it takes before that gets adopted, but who knows? The Asian community, I think El Salvador and the UK are all developing their own stable coins right now. The US is a little far behind, but the Federal Reserve's at least thinking about it. I don't know. I think it'd be a while before then because of regulations that they probably want to put around it. And then the last one, I think it's the last one I have. Yeah. The last type of altcoin is a wrapped coin. So it's a crypto pegged to another crypto. So we have a stable coin which is pegged to the dollar. A wrapped coin its value is a derivative of another cryptocurrency, which it's like, I don't know why you would want one. I mean, why not just get the original cryptocurrency it's pegged to? But REN BTC is a wrapped coin whose value is pegged to Bitcoin. Yeah, I guess for a lack of a better term, it's like its own ETF because it's derived from the original. And then there are others pegged to Ethereum and Bitcoin. So for me, I would just buy the Bitcoin. It's definitely more liquid than the wrapped coins are. So the derivative coins, I guess, anything to try to separate people's money from their wallet. So FTX was a crypto firm, so they were like other crypto firms, like Coinbase. FTX was the facilitator between the investors and the blockchain. Unfortunately, Sam Bankman-Fried decided to personally dip into the honeypot as he was purporting to be the middleman. Kind of spent a lot of that and not invested like they were supposed to.
So my next question would be, what would their
the FTX coin would probably be. Yeah, so let's take a look and see what kind of altcoin that would be. Yeah, it wouldn't be stable or wrapped. I would say it would be either a utility or governance token. Mm-hmm. So it's moved.
Yeah.
Okay.
So when
Makes sense.
When I make money on
Right to the stable coin.
when I know the market's going to fluctuate.
Yeah. Well, yeah, because you're not cashing out into the real financial institution. That's the move. Mm-hmm. Oh yeah, that's a benefit. Yeah. Yeah, it's the halving.
The halving, yeah. Coming up on a half year.
It's next year? Okay. I never remember when those intervals are.
So next in.
Yes.
It's very small.
It's gonna be half of that.
Yeah. Well, so right now, 6 next, I think you going to go up.
Well, I guess theoretically, due to scarcity, it should. I'm really hoping it does.
Yes.
I want to see that. I want to see my Bitcoin go back up to where it was 2 years ago. So,
Yeah.
One of the last things I just want to say, my officers for 2022 did such an amazing job. They graduated in the fall. So for those of you in the WebEx world, or here live or tonight, which be later, I'm still wondering if anyone wants to or interested in being an officer, that'd be great. We only have 4 officer positions, so president, vice president, which are pretty much the same, secretary, which just tracks members, and then treasurer, because we do get a budget from student activities to do things. So that's it. But a lot of the groundwork's been done. We got our banners done. So we're coming up on our budget request period for the club, which is in April. So it'd be nice to have a treasurer at least during that time. First year that we chartered the club, I had to attend the meeting because I didn't have any student officers yet. And so that was kind of weird because the faculty member is not supposed to be in those meetings, but I kind of had no choice. So thank you for joining us. If you signed in or signed up on the sheet, you get the extra credit. So I'll be continuing to grade for this semester over the next day, and I'll stick your extra credit right in the grade book. All right. Thanks for coming, everybody. All right. Thank you, everybody online. Thanks, Samantha. Thanks, Timothy. Thanks, Tony.